Welcome to the second part of our pipeline hedging session. The first one was recorded quite some time ago and I apologize for delay, but unfortunately it was very busy time and I didn't manage to record it, the second part. Now I'm going to focus on the nonlinear instruments for pipeline hedging. And these nonlinear instruments are quite common also in other cases. And I have seen the use of interest rate options, because we are talking about interest rate options, quite in many hedging solutions. And I will be walking you through also through prepayment hedging and some sophisticated strategies which include swaptions. So yes, because we are talking about swaptions. So swaptions, as I said, belongs to the family of interest rate options, together with caps, floors. These are most frequent popular instruments, obviously with non-linear payoff, which means that there is optionality. And just in the contrary to the linear instruments, which are swaps, you have this exchange of cash flows where one party receives and at the same time is paying another stream of cash flows, which obviously is netted, so there is the net position. In case of option, it's not the case, because options, as the word is saying, can be exercised, but also can happen that they are not exercised. And depends on the very rational situation. So if something happens, like rates, in this case, rates are at the certain level, then we can say that the option will be exercised. And in the contrary, if the situation does not happen, so the rates do not reach certain level, then the option is out of the money. This is how we call it. So it's not exercise and basically is worthless. So we are paying the cost of the option, but we don't have any protection. So swaption is some kind of insurance which against the rates moving sharply up, for example. And in this case, we want to buy the protection. If it happens, then we have the possibility to enter, in case of swaption, into the underlying swap at certain rate, which was negotiated at the situation at the moment of acquisition of swaption. So we decided to enter the swap at the certain time in the future at certain rate, if rates move up to the certain level or above. And this is term of the strike. So we know that there is strike, which tells you what is the trigger, which will define if the option is out of the money, or if the option is at the money, or if the option is in the money, because these are three terms of optionality itself. Very important situation for Treasury when we have fast moving rates environment, moving up. And this is exactly the case, what's going on in Europe, in UK, United States. We have rates moving sharply up. This is very dangerous situation for the lending business, because especially for the loans which are going with long pipeline. And always commercial mortgages, retail mortgages, they are going through this situation where you have a lot of sub categories of the pipeline. So the first one, when you are issuing the offer to the customer, then we spoke about it in the previous video. So you have the stages of the pipeline, which can last even up to 6 months. In the meantime, the rates could go, in 6 months. It's for such a high, sharply moving rate environment. it is a dangerous situation because we can obviously lose in terms of the margin compression, because you are originating the loan at the certain level, let's say 4%, then you are locked because you are committed to the customer to maintain this rate at 4%. Then over 6 months, market moves moves to 6%, let's say, and 2% is your margin compression because you have committed the 4% level to the customer, but at the same time, market has moved and is at 6% now, the swap rate, for example, for 5-year tenor. So Treasury needs to step in. And if you don't hedge the pipeline, then potentially you can run big P&L, negative P&L impact. Obviously, this is because your product at some point are not earning the required return on equity. So obviously it's become not attractive, and this is the value destroyer for the bank rather than a value additional value creator. So some products, unfortunately, we always assess the product from the profitability standpoint. So interest rates moving sharply up is one of the reasons why the product can be not profitable in the very short time period. So Treasury, as I said in the previous video, one tool to manage this risk is entering into the forward starting swaps. But we also said that there is another potential tool which is very important in the short term, when the rates in short term are moving sharply up, and these are swaptions. So in this case, obviously, what we want to achieve, we want to enter the payer swaption because there is the underlying payer swap. So we want to be able to enter potentially the swap, payer swap, whereby you will be paying fixed rate and receiving floating for certain tenor and at the certain rate. So for example, imagine you have the rate, you locked in the swap rate in the mortgage of 4%. Now, obviously, you would like to mitigate the risk of the transaction. You are acquiring the payer swaption with at the rate of 4%. But it only happens, if the rates move up to the certain level, so to the 6%. So you are happy to accept the risk between 4 and 6, because you will be exposed at that, and I will show you in the exact example, you will be exposed to the margin compression, obviously, in this range, but this is what you are agreeing. And then if the rates move up 6%, then you are entering into the swap rate which has been agreed with your counterparty, which is obviously lower than the prevailing swap rate, because this is exactly the situation. So you want to make sure that you are locking in the swap rate above certain level which you are not happy to risk accept. It's not easy concept, I'm fully aware, but let me maybe go through the example. And I've prepared the example which you can see on the screen. So this is the typical example of the margin reduction in a rising rate environment, and how the swaptions work exactly, what is the cost. So it looks very busy, but I will try to walk you through so it becomes more clear. So in these cases, you have treasurer who decides to analyze 3 hedging options to manage the pipeline risk in the banking book. So the first option considers entering hedging a highly confident minimum volumes with swaps. 50 million. Let's imagine 50 million. And we have our own analysis. We know that we are highly confident that we will underwrite this 50 million of business. So we are hedging the 50 million of business of the pipeline, which we expect to be drawn down with high certainty with forward starting swaps. So we are entering swaps. But the remaining portion, in this case, we have choice to leave unhedged or to enter the swaption. Leaving unhedged has obviously the consequences because you are subject to the rate volatility and to the potential margin compression. So the second option, as I said, aims to protect against rates moving up through acquiring a payer swaption with strike at prevailing rate. So we call it in our ILM jargon at the money plus 10 basis points. So you can see this situation in the second strategy, which is here in the middle. One column is showing the impact, P&L impact annualized, and another one is showing the P&L impact multiplied by 5 because the loan is 5 years. So this is what we want to see, quantify the impact over the whole life of the loan. So 5 years. This is why you see it. You see two columns which quantifies the impact. One is annualized and another one is for 5 years. Now, the second strategy with the swaption envisages covering up volumes in excess of 50 million of minimum drawdown level. So I will enter into detail of the second strategy very soon. Let's introduce the third option. The third is again similar. So we are hedging the second part, which is 50 million with swaption, but the swaption has the higher strike. So the swaption will be cheaper. So we decide we have our view that the rates only above certain level of interest rates, we are going to have this protection. In the meantime, so in the range of, there is some risk acceptance. So if the current swap level and the level of the strike is unhedged under this swaption. So swaption with the higher strike means that there is the higher risk acceptance. Okay, this is very important. So let's maybe summarize again the strategies because it's quite important. So the first strategy, we have total pipeline in all is 100 million. 100 million of loans, 5 years loans are going to be delivered, to be originated. Hedging strategy number 1. 50 million is hedged through forward starting swaps. 50 million remains unhedged. Option number 2. 100 million hedging strategy. 50 million hedged with forward starting swaps. 50 million hedged with payer swaption at the money plus 10 basis points. Option number 3. Total pipeline 100 million, hedging strategy 50 million hedged with forward starting swap, 50 million is hedged with payer swaption with higher strike, as I said. In this case, it will be at the money plus 25 basis points. So you can see that there is difference between option 2, option 3, because option 2 has swaption with lower strike. So basically it starts to be kicking in when the rates are 10 basis points above the current rate, swap rate, 5 years swap rate. So imagine it's 2%. So when the rate will be 2.10, then swaption starts kicking. So the swaption is becoming in the money. So it's executed, we are saying. So we are entering the underlying swap. Now, there is no right answer to the question which option is the best for Treasury to hedge this particular situation. It depends what we believe will be our future interest rate outlook, and it's up to Treasury to decide which one, in their view, is the best one to pursue. Obviously, you need to understand it is option, so you have to be prepared to accommodate option in your banking book. So from a hedge accounting perspective, from accounting perspective, from a modeling perspective, so you need to have the pricing model. And obviously, in the IRRBB modeling, we know that this is automatic option, which has to be included in the IRRBB framework, both under EVE metric and under NII metric, because these are automatic options. So you have to include them as per the new standards on interest rate risk in the banking book. So let's analyze, let's quantify this. The hedging option one, where the rates, because we have some scenarios, obviously on the left side we have the scenarios. So we see that under scenario one, it is written there in the blue, dark blue column. You see that under scenario one, the interest rates won't move, and the completion is 50%. So exactly the minimum which has been envisaged by the pipeline modeling, by the pipeline modeler. Then scenario two is, again, interest rates movement is constant, so the rates are not moving constant, which is obviously a theoretical situation, but let's analyze it for the sake of the exercise. And completion is 100%. So we were expecting 50 as a highly confident level, but we have 100 completed. Under scenario 3, rates moved up by 10 basis points and completion is 100%. And then scenario 4, the rates moved by 15 basis points, completion rate 100%. Scenario 5, rates moved 25 basis points up, completion rate 100%. Scenario 6, rates move up by 50 basis points, completion 100%. So obviously we see that under rates stable, so not moving up and not moving down, stable, constant, we won't have any P&L impact. Our swap rate is basically unchanged for both scenarios. The completion rate in both cases is irrelevant as well, because there is no margin compression. So the situation is obviously changing while rates are moving up. So under strategy 1, the Treasury enters only the forward starting swap with notional, which is equal to 50% of the pipeline, so 50 million in this example. And the interest rate swap starts in 3 months' time, and the tenor is 5 years. This is what we said in our last video. We are aiming as a pipeline hedging. So we are entering, we assume that the time lag between the origination of the loan and between the drawdown is 3 months. So this is also valid for this video. In case rates move up by 10 basis points, and this is where we need to focus, because this is where the all difficult aspects of hedging through swaption are coming in. So imagine rates are moving in this 3 months time period by 10 basis points, by rates, 5-year swap rate, because this is the underlying rate for this instrument, for this lending. And there is obviously negative P&L impact of 5 basis points in the situation where only 50% is hedged. so unhedged portion of the pipeline. And given that not whole pipeline is unhedged, but only 50%, so you assume you are quantifying your P&L impact, negative impact, so your P&L cost of 5 basis points on annual basis. For 5 years, it will be obviously 25. So you see this here under scenario number 3, under the first two columns. So the first two columns are showing this situation when we are hedging 50% with forward starting swap and 50% remains unhedged. Then, when the rates increase by 15 basis points, so this is number 4, 15 basis points, we have similar, like in previous case, 50% of the rate move up, which in this case is 15 basis point, which means that 7.5, half of this, is your cost, which you are running on this scenario, because 50% of the pipeline is not hedged. So only on this portion you will see the P&L impact. Obviously, the rest is hedged. Then you have similar half of this, which in this case is 12.5. Half of this increase in this case is 25 because it's 50 basis point increase. So half of this is 25 basis point. So I hope this one is quite clear. So we have hedged, unhedged portion. The unhedged portion obviously is subject to the P&L impact as rates are moving up. And this is because there is the impact there is margin compression. And if you want to quantify this loss, this is exactly how we quantify it. So we see that this is the 7.5 basis point on the 50 million of unhedged portion of the pipeline. Yeah? So this is how you would quantify how much you have lost in terms of them, or you suffered from margin compression under this scenario. Then under option 2, Treasury acquires the payer swap with, we said this, with the strike equal to prevailing swap rate plus 10 basis point. And there is a cost. Swaption is not for free. You have to pay the premium. And the premium of this option is, let's assume, this is just my invented, what could be potentially cost of this option, 8.72 basis point. So annual cost is 8.72 basis point, which means that you will be paying on the annual basis, independently of what scenario is outside in the market, you will be always facing this cost. It's known as the cost of the option. So you have 8.72 basis point, which is annualized cost, and over 5 years you can see the number here on the left side. What happens though if the rates move up by exactly 10 basis point? So the swap won't be exercised, we said, for the rate level below the strike. The strike is plus ATM plus 10 basis points. So at the money, so prevailing swap rate plus 10 basis points. So in practice, it means that the pipeline is unhedged until swap level reaches the swap strike. So ATM plus 10 basis points. And therefore, there is negative P&L impact driven by the annual cost of the swaption plus an unhedged portion of the pipeline. Because the pipeline for the 10 basis point is not hedged. It's not hedged because the option is out of the money. The option has not kicked in because it's not executed. It's not, does not have any value, is worthless at the moment, yeah, from the economic standpoint. I mean not from the time value of the option. So for this particular case, we have 10 basis points which remains unhedged. So we are accepting on the half of the total pipeline, which is 100 million, half is 50 million, and we are accepting that there is the loss of 5 overall. This 5 basis point plus 8.72, which is the cost of the swaption. So therefore, this is your total number, 13.7. This is how it was calculated. So you have the cost of the option, which you will be paying. And then you have also the cost of the 5 basis point, which is coming from move of 10 basis point up for the curve. And this is not hedged by the option. And it is half of this because we have 100 million of the overall, but 50% we said is hedged by swaption, not 100. So it is half of the pipeline. And then we have similar thinking already, because similar thoughts are applying to the scenario when we have the next impact is of, apologies, my eyes are not very good, 25 basis point. So in this case, 25 basis point, because we have the originated 100% plus the scenario is 25 basis point up. And again, under 25 basis point up, you have the cost plus you have unhedged portion, which is again here you will get because it's half of this and plus the cost of the option. Okay, so you have this number, and again the same, because over this the option starts working. So once you reach the 10%, because the option is at the money plus 10 basis points, apologies, but I don't see. So this is why I have very weak side. So this is why you have 10 basis point is the strike. Okay, prevailing rate plus 10 basis point. So this is your strike. So when the rates move up by 25 basis point, again, we have 10 basis point, which is not hedged, but the rest is already hedged. The swaption has been executed, has been transacted, and therefore it is hedged. So only 10 basis point is unhedged. From this is 50%, so 5 basis point plus the cost of the option. This is why you have the same number here, this 13.7, 13.7, 13.7, because only plus 10 above the strike, which is, this is the strike of the option, exposure is already hedged through swaption, through exercise swaption, which is you are entering the swap. So, and then it becomes hedging, it's hedging, affecting hedging of the residual portion of the pipeline. So, yeah, I hope you enjoy it. I appreciate its swaptions are quite not so much transparent like swaps, for example, but it's also very useful instrument to hedge the balance sheet. Thank you very much. The next session we will be walking through the prepayment hedges. Thank you.